because energy prices are too high and smelters cannot smelt the zinc that needs to be dug out of the ground. So there is a bottleneck that cannot be solved here without a reset in the monetary system, I believe. Well, hello there, my friends. Rafi here from the Endgame Investor with this week's silver report for Arcadia Economics. And today we're going to talk about some zinc. We're going to talk about Exeter's pyramid. And we're going to talk about, even though we have some banksters talking about peak inflation, by which they mean peak consumer price increases, they are wrong no matter what the CPI does, because the monetary system is dying, and I will show that to you with one simple number. Let's begin with something conceptual, and that is Exeter's pyramid, where silver is in this pyramid, and what is actually happening in a financial collapse. This picture here is Exeter's pyramid. Exeter was a central banker, and he was relatively honest, especially if you're comparing him to today's central bankers. This pyramid shows you the structure, the very basic, crude structure of the financial system. Now, if you look at these numbers underneath, everything is pyramided on top of the other thing. You have gold, which is $8 trillion worth, let's just say. Paper money on top of that is about 119 trillion digital paper dollars, 10 trillion physical. And as you go up and up and up, the numbers get more and more and more. $210 trillion of unfunded government liabilities and 1.2 quadrillion of derivatives. Question is, does this money actually exist? Does this value actually exist? And the answer is no, because that much money, that much currency doesn't exist, and certainly not that much gold. So when you have a collapse of a pyramid, what is actually happening? It's not money being destroyed. The money is never there. Now the question is, once it collapses, what is happening? The value that is notional here, let's say, this $1.2 quadrillion in derivatives. Everyone who owns derivatives thinks they own a piece of that $1.2 quadrillion. When it all falls, it doesn't fall over, it falls in. And it goes down the layers and finally into gold, but not finally into gold, because below gold, which Exeter did not put in here, is actually silver. And why is gold based on silver? Because silver is the original money. Silver was demonetized in 1873 in favor of gold. Why? Because rich people own gold and middle class and poor people own silver. It was a classic transfer of wealth from the middle class and poor to the rich. That is why the standard for the dollar was changed from silver to gold in 1873, and that caused a lot of poverty among the middle class. And that is why the old ratio of 15-to-1 only restates itself in times of monetary panic, when silver is preferred to gold, because silver is the real money and gold is the money for capital transactions, whereas silver is the money for retail transactions, and most transactions are retail transactions. Conceptually, what is happening during the collapse of a monetary system is that all of this notional value plunges itself down into the pyramid and finally to the tip of silver, which is why the purchasing power of silver is going to rocket much faster than the purchasing power of gold. And all of this stuff in the economy, all of the real stuff in the economy that is represented by all this paper that doesn't exist in reality, will plunge itself down into gold and silver most of all, when the ratio reaches 15-to-1 again. And that is when we can start spending our money and accumulating real assets in the new economy. Now let's move to inflation. This is the producer price index. Just came out yesterday, and there is one number that I will share with you, very obvious, very large, that is not being talked about by any of the mainstream media. What matters here is food prices, and we can see in the producer price index the month-to-month sequential gains. You see here the column foods, I'm highlighting it now, go down, and you can see the month-to-month sequential gains in food keep getting higher and higher. So we can see very clearly here that food inflation will keep going higher. Food price increases. And why is that the only thing that matters? Just think about it logically. If you have, let's say, a society that is so poor because their money is collapsing so fast, the value of their monetary medium is collapsing so fast, that they can't afford food, then all of their purchasing power gets concentrated in food because that is the most important thing, and that is inelastic. People need to eat the same amount of food every month if they want to stay their own weight and survive. So if you have a society where food prices are increasing and they can no longer afford cars, what's going to happen to the price of cars? It's going to fall as you get less demand for cars and more demand for food. So you'll have prices falling in other categories of prices rising in the most basic necessities, which is what is going to happen. So watch food prices. That is the only thing that matters. The prices of other luxuries matter less. And the end value of the CPI number that they calculate, all items, doesn't matter at all. Just watch food prices. Another thing to watch on the inflation front, on the price increases front, on the consumer level, is this chart from the New York Fed showing the difference between 1 year expectations in inflation rates and 3-year expectations in inflation rates. You can see here that they are pulling away. 1 year inflation expectations are pulling away from 3-year inflation expectations. One is going up, the other is going down at this point. They are diverging. First year they were separating, now they are flat out diverging. What does this mean conceptually? Let's put it in our heads. Let's say you go back to Weimar, Germany, and you ask someone in 1922, 1923, what do you expect prices will be 6 months from now? And they'll say something like, I don't know, 10 times higher, 100 times higher. It's crazy. And then you ask them, well, what do you expect prices to be 3 years from now? You know what they'll say? They'll say, who cares? I got to buy what I need to buy right now. This is when short-term inflation expectations diverge from long-term inflation expectations because people are trying to get rid of money to chase the shorter-term maturities in inflation. This is exactly like backwardation in a commodities market. When you have spot prices higher than futures prices, the price of the thing goes higher and higher and higher in a shortage. So when inflation expectations in the short term diverge from long-term expectations in the longer term, you have what we would call backwardation in the price expectations market, which is money itself. People expect the value of money to fall faster in the near term than in the long term, and that's when people start dumping. Next, we're going to zinc. Remember what happened in nickel? There is a warning that it could happen in zinc, and yes, it will happen in zinc. In paper futures markets, it's not only precious metals manipulation. The entire futures market is a manipulation of all commodities to a certain extent. Why? Because it operates on margin, which means you get people that only have to put down a certain percentage of what they want to sell, and then they get the leverage to that price exposure. So when you have someone, for example, shorting zinc or shorting nickel or shorting silver, they do not have to have the actual physical stuff behind them. So when you have all these short contracts, you have a notional amount of zinc or nickel or silver or gold that does not actually exist, and that fools the market into thinking supply is bigger than it actually is. But once these physical supplies are called in for certain reasons, which I'll go into a second, then what you are going to have are flash short squeezes when the supply of these contracts suddenly has to contract because they do not have the physical to cover it. And this is not just a financial phenomenon, it reflects reality because it is the revelation that all of these short contracts are not backed by anything and the actual supply of zinc is a lot lower than the market actually thinks, or nickel or silver or gold. So why is this happening? One simple paragraph. A raid on LME zinc stocks has seen available tonnage fall to 2-year lows. Traders are tapping the market of last resort for metal to ship to Europe, where smelting capacity has been idled by high energy prices. Basically, what you have here is a bottleneck of smelters that cannot smelt zinc because it costs too much money to smelt zinc, and their margins become negative, so they stop smelting zinc. So there is no zinc, so the only place you can get zinc is London Metal Exchange, which was never intended to be used for actual commercial purposes, but now it is because there's nowhere else to get it. So here are two tables that I gathered. One is from MMG on the top. MMG is a zinc miner in Australia, I believe. You can see here its silver production is 7,621,998 ounces in 2021. Obviously, a zinc miner is not a primary silver miner, but a lot of silver comes from zinc miners. And now here you can see on the bottom, First Majestic, which is a primary silver miner in 2021. In total, the amount of silver mined by a primary silver miner was 12.8 million ounces. A zinc miner producing about 60% of the silver that a primary silver miner produces in a year. Here is a zinc smelter, Nexa Resources. This is a company that basically smelts zinc. Now, when a miner gives Nexa its zinc at a high price, are they able to smelt it? No, because the energy that they need to smelt it costs too much. They have to shut down operations. And so the higher price of zinc is not going to help them because they can't smelt the stuff. And even though zinc is almost at an all-time high again, you don't have that reflected in their stock prices. There's a bottleneck here that can't be widened because of higher energy prices. And that's why the whole zinc market is suffering. And that's why we could see a short squeeze in zinc, which would take down a lot of traders. But it wouldn't do very well for the smelters, or for that matter, necessarily the miners, because the miners can't make money if the smelters can't smelt it. Here to talk to us about zinc's impact on the silver market and the relationship between the two, we have the CEO of Fortuna Silver Mines, Jorge Ganoza, who I had the pleasure of speaking with this week on the situation in the markets. You were telling me last time we talked that a lot of silver comes from base metal mining, and you don't find it elementally, you find it in mixes with other base metals. So what do you think a zinc short squeeze would do to the silver market, and how much silver is actually gotten from these zinc mines?
Well, the largest silver producers in the world are either large copper mines. Zinc is trading near its historic peak. The previous time we saw zinc at these elevated prices, it's trading currently close to $2 per pound, right? 197, 198, peaking at 2 a few days back. We haven't seen those zinc prices for, what, 25 years? We're in unprecedented times. I mean, our generation has not lived through this type of inflationary environment. But I do interact heavily with investors and institutional investors. The other day, I was in New York last week marketing Fortuna, and I sat at a table with gold investors. They manage money in gold. These are gold funds. And one of the fund managers asked, well, who's invested in Bitcoin? And everybody raised their hand. I see that the money managers, the institutional mainly, are what they would traditionally allocate all into gold. Now they are putting a bit of it into gold, and then they are also allocating funds to things that resonate with everybody, the green revolution and the metals that fuel the green revolution. And watch out, because, for example, Mexico, the Mexican president went public yesterday saying that he's going to nationalize the lithium industry, right? He's been talking about it for a while, but he's saying, no, lithium in Mexico is just going to be like oil. It's going to be in the government's hands. We're going to take it away. No? Yeah. So he's going to, he said yesterday, I'm going to nationalize the lithium industry.
And so next week, maybe we'll see another base metal squeeze, which will affect the zinc miners, which in turn will affect the silver supply, because a lot of silver, most of the silver comes not from primary silver miners, but from primary base metals miners and silver as a byproduct. Once John Extra's pyramid collapses into itself, yes, gold will be a primary beneficiary, but underneath that gold base is silver, because before the dollar was gold, the dollar was silver, which means it still is silver, which means that ratio of 15-to-1 is still alive, and it will reveal itself once the pyramid collapses into itself. This is Rafi of the Endgame Investor coming at you with this week's silver report for Arcadia Economics. Happy Passover to all those celebrating tomorrow night. I will see you next week.